All right, everybody, welcome back. I don't know what number panel this is, but it's been a great 2 days. We're pulling it up towards the end here. Let's finish things on a strong note and kind of close it out before the cocktail hour. I'm Peter Gaffney, head of research at Secure Token Advisors, our consulting group, as many of you have probably heard or are aware. We have today the institutional payment, rails, and settlement panel. My pleasure to be joined by Leo Mizuhara of Hashnote, Prakash Neelakantan of Broadridge, Arin Ray of Zero Hash, and of course Jason Barraza, also co-moderating with me from Secure Token Market. I'm sure everyone very familiar with him as well. If you want to just go down, and Leo, if you want to tell us a bit about yourself specifically, about your firm, just to give audience good context, and we'll go down the row.
Sure. Nice to meet you all. I'm Leo Mizuhara. I'm a 17-year, I guess, veteran of traditional finance. Worked for DRW previously right before starting Hashnote with DRW's backing. Hashnote itself is a on-chain first asset manager. So we focus on all things that are asset management that can really be accelerated with tokenization and other on-chain activities.
Hi, I'm Prakash Neelakantan. I work for Broadridge. I drive, actually, at the corporate level, our digital asset and blockchain strategy. Broadridge, for people in the capital markets world, they would not need an introduction. They would know us. But for people who are not familiar with us, we provide infrastructure for everything from trading to post-trade settlement services for banks and brokers. We also actually provide investor communication services and governance for most public companies in the US. So that's our two core businesses, actually, what we call trade operations and investor communication services. And we have been using blockchain technology or experimenting with it for maybe 8, 9 years now. And we work with private blockchains, or permission private blockchains, because of the regulatory needs. And focused on a few specific use cases, I think, which I'll discuss some of them today.
Cool. Hey all, Arin Ray. I lead sales engineering and tokenization rails over at Zero Hash. Zero Hash is the largest regulated crypto infrastructure provider no one's heard of. We power experiences like Stripe, Interactive Brokers, and have recently gone into the tokenization space by powering crypto on and off ramps, USDC funding to platforms like TokenizeThis and a few others. So excited to be here.
Awesome, guys. So as you guys can see, we have a variety within the panelists themselves. So that being said, there is an overarching theme. So why don't we start with, for example, repos. Tell us a little bit about the use case for repos being on-chain and what you guys think the opportunity is there.
So the repo markets are some of the largest markets in the world, actually. I think in the US, I think it's around overall 4 trillion, 10 trillion globally. We support many of the primary market dealers involved in that US Treasury repos. Right? When we looked at potential uses of blockchain and smart contract technology or distributed ledgers, we thought that there could be more efficiencies if there is a coordinated service, actually, which enables better workflows and efficient movement of collateral between participants. Repo, as you know, essentially is cash for collateral. And so we launched this platform, I think, around 3 years back, 2.5 years back, I would say. And today we do around nearly 100 billion volume notional daily, maybe around $1 trillion on a monthly basis. And what we do is we immobilize collateral at the custody level and allow the digitized form, actually, to transact and move efficiently, instantaneously. We still connect to traditional payment rails because there is no real cash on ledger yet. But that's the path that we would like to go to. And the goal is very simple: improved workflows, efficiencies, cost savings for our customers as they deploy this platform. And we support a variety of, we started with, to build a network from scratch is the real challenge, as always. And we had to, and banks are willing to invest if they get real benefits immediately. So we worked with inter-entity, what we call transactions first, approved the benefit, moved to bilateral transactions. Today we support, actually, in a path to support sponsored repos, as they're called, towards the path towards cleared repos, which are coming in 2026. And also intraday repos have become more important for managing liquidity. So we have the same platform supporting different use cases. of repos. But the essence is essentially that we integrate with the existing financial institutions' workflows. We didn't need them to forklift anything, change anything. Makes adoption much more easier.
Yeah, I think the repo use case is like by far one of the biggest use cases here. Collateral settlement in general is one of the biggest things that we can do quickly and more efficiently than traditional finance. I kind of want to shout out to the Canton guys. So like the private blockchain that he was talking about is actually Canton, which is made by Digital Asset Holdings, which is another company that got started from DRW. So I just like to point that out. But yeah, they're making a fantastic product, and there are places where there are regulations that don't allow us to use public blockchains, where you need things like Canton to be able to provide that level of service. So I think that's it's an interesting observation to see that there are sometimes requirements for different types of blockchains, and therefore this like multi-layer one solution is almost certainly going to be part of our future blockchain world. And in addition to that, this was special made to be specifically superior to traditional technologies, right? We can now settle faster when there is a digital cash available. We'll be able to do that repo transaction in a much more streamlined fashion so that we can do intraday repo, for example, in a way that isn't quite so kind of chaotic. Right now, intraday repo is kind of a bilateral transaction between banks, and it doesn't feel like a marketplace as much as it does on something like Canton. So we at Hashnote are actually also looking into using this Broadridge solution on Canton to do our repo as well. So really excited about that use case, and I think it's one of the best use cases to date in the market right now.
Is there collaboration on that directly between Hashnote and Broadridge in that case?
Not yet, but
Not yet.
maybe soon, yeah.
Nothing yet. But we welcome participation actually from the buy side, and because that's what is going to grow the market. They are the largest providers of cash and collateral in the markets anyway.
Yeah, we're hoping to be the first buy-side firm kind of involved. I think right now it's mostly banks, like all banks pretty much, yeah. DRW did one clip, yeah.
DRW was involved. They are involved in trades, repo trades, especially in the intraday market.
And actually, speaking of DRW and the Canton network that you guys are referring to, you guys recently did a series of experiments on chain and whatnot through the Canton network. Are there any of those? Did any of those have anything to do with repos? And are there any operational savings that I know Prakash, you mentioned operational savings a little earlier. Maybe you can give us some quantitatives on that.
Yeah. So I mentioned workflow efficiencies, right? So that's one part. That's the operational savings, right? Typically, I think we see if customers are flowing around 100,000 transactions through the system, they'll save at least $1 million. Right, so for every $100,000, 100,000 transactions, they will save $1 million. Right, obviously you get the added benefit of capital efficiency, better rates. Right, all of those things are add-ons.
Does the size of those transactions matter? What is the size in those 100,000 transactions to get that $1 million in savings?
The side, you're saying? No, see, it's inter-dealer market, right? So I think that it's a bank-to-bank transactions. One is a collateral provider, other is actually a cash provider, and that's what repo puts both of them together, actually, right? But today it's primarily U.S. Treasuries. The collateral is primarily U.S. Treasuries.
Prakash, on the sponsored repo side, is there any interaction? I think like UBS, SocGen are a couple of examples actively doing that. I'm sure there's many more behind the scenes. So their clients don't need to interact directly.
No, because
with that whole process.
So see, as a sponsored repo, the banks, you mentioned two bank names, they stand in front actually as a prime or clearer in front of their customers. So they interact directly with the network. The end, so that's the model actually. But we don't mind actually more participants coming directly to the network.
And then that, let's say the $1 million saved every 100,000 transactions, like some of that gets passed, through to those clients, back to Broadridge or to the banks themselves. I'm sure there's some breakdown there.
Obviously, the banks get the benefits actually, and they either they decide how they will redistribute it, but it's benefit for all participants.
Another way to say that they don't pass it on, but that is actually why we're interested in the space. Typically when you leave money at a bank or when you have a bank money market, you are invested to some extent in reverse repo and in treasuries and in bills, but the intraday repo part usually doesn't pass through the clients, which is interesting. We have a money market product called USYC, which we use primarily as a collateral vehicle. But one of the reasons we're interested in using Broadridge is because we want to access that intraday market, which is primarily reserved for banks, in order to boost the yield of our money market product, that we really pass that yield straight through the customers. So that's one of the things that we think we could really improve in terms of collateral efficiency and the ability to provide interest-bearing collateral for clients directly by using this blockchain technology and accessing these markets that are usually reserved for banks.
Yeah, I think there is great value in actually leveraging these platforms for benefit of actually all, right? New products. The problem is money market funds can be equivalent to cash, but the reality is actually the collateral agreements need to be repapered to accept them. And obviously that's a process, hopefully, and as things move forward, we'll have more and more of potential uses of that. Like I mentioned, we don't do atomic settlement because the cash rails is still traditional, but it's near real time, actually, in terms of existing cash versus collateral settlement. But we are planning, we look at it in 3 stages, right? Our initial work was actually all in workflow improvement and process improvement, which we have done. The second stage is obviously connecting to cash and ledger. And in the next few weeks, you will see some announcement from us of us interacting with different cash and ledger providers, whether it's deposit tokens or alternates. And obviously, the final point would be actually leveraging collateral of natively issued tokens actually on the platform. But that's a little further away as things forward come.
And speaking about this, Arin, you guys recently integrated into TokenizeThis. Are you guys involved with BUIDL, or how do you guys power these markets? And what are your thoughts on treasuries, stablecoins, money market funds, liquidity products?
Yeah. So TokenizeThis integration is a really amazing one. They have a platform that allows tokenized funds to be accessible to retail investors, entity investors, and anyone that really wants exposure. So, don't want to comment on any fund in particular, but we are able to power any fund that TokenizeThis has through our funding rails. And by funding rails, I mean USDC funding, meaning an investor has crypto or USDC, and the fund needs a USD wire. So Zero Hash is able to show a deposit address, basically run the full life cycle of that financing directly into that tokenized fund. On the flip side, if someone wants to redeem shares of their fund, we can send crypto back on-chain to the end user who wants to now redeem their tokenized fund for their USDC back. So we see tokenized funds. Some of their top customers are folks that hold stable coins and crypto today, and we're here to power use cases just like TokenizeThis for any other player in the space.
And from the press release, it was 24/7, 365, right?
Yep, 24/7, never goes down. Whenever you want your redemptions or investments, we make it happen. It's pretty cool because, in a regular money market fund, if you wanted to take your money out on a Friday for something else, you might not get those funds in your bank account until maybe Monday or even Tuesday with T+2 settlement. In our case, you could put a request that you want your tokens to turn back into USDC on a Friday, and you'd get that within minutes of making that request, all powered on chain.
Awesome. Arin, great context there. Something we hear a lot about lately, I mean, it's been a while, but especially lately, a lot of the commercial money bank tokens, deposit tokens, bank-to-bank transfers, like intra-bank transfers, different divisions of the same bank moving, wealth around. What are you guys looking at in that space? Any of the 3 groups here on stage? Like anything on the banking side specifically for the transfers? Can we use USYC to power a lot of that, or do you think a lot of that is happening kind of behind the scenes?
Well, I guess USYC is primarily built for use as collateral at things like exchanges, at places where you do OTC trades. Like in traditional finance, normally when you post collateral, you expect interest back on that collateral when you post it. Somehow within crypto, we've decided that it's okay that Circle and Tether make all that money. So we're looking to really change that paradigm. As far as intra-bank transfers go, that should just be a ledger movement. In the case of a bank moving money within itself, right, that should be a private database. So whenever you hear something about a blockchain being used for a private purpose, you should be somewhat suspicious that that means anything at all, because that's really just a ledger movement internally, which is a database change. And so like I've not actually seen very many of those, but I have heard of a couple, and they always make me quite suspicious that they're using the blockchain name to like make a news announcement. But yeah, they would actually be more efficient using a normal database, and they're probably wasting money trying to make it a blockchain event.
I mean, it's just great in general to see this conversation right now anyway, just because when crypto first came to be, it is 24/7, banks aren't. Now banks are becoming more 24/7 with the Fed now and internal bank transfers and basically saying we can move money just as fast as crypto, and then crypto goes, we'll tokenize your money market funds and even add more utility. And instead of working against each other, TradFi and crypto are now almost working together in parallel to actually use the core technology and not worry about the speculation that often comes to crypto. So in a sense, we're almost forcing utility down now finally and bringing crypto to the people as opposed to bringing people into crypto.
Yeah, that's a really interesting point, right? I think, databases are 24/7, right? All this technology has always been 24/7, and the banks have really just been too lazy to let you move your money around on the weekends. And now that crypto is there to force them to say, hey, like, we can all do this money movement, what about you? Yeah. Now they're finally turning these things on.
There was even news that the New York Stock Exchange is trying to offer 24/7 trading. On Robinhood, I think you can already do that. And they probably got that idea from assets that already trade 24/7. So really cool to see it.
Interesting. And I mean, in terms of the intra-bank stuff, I think a lot of it is like just test cases, right? I keep talking about product distribution to like private banking clients. So I think the buzz is like, how can we at least get used to this stuff with other divisions that we don't directly interact with? And that's probably where a lot of that's coming from.
Yeah, private banking clients, I think, have some pretty specific needs. In particular, when you're thinking of private banking clients, we're thinking of high net worth individuals, people who often have needs internationally. So crypto rails start to help a lot because most banks can't do just that internal transfer of money from their entity in the US to their entity in Europe, for example. So at that point, you actually do need to use blockchain rails. So I think blockchain rails will be big for FX and for things like remittances. One of our partners is actually PayPal, Paxos, and the whole PyUSD ecosystem. I actually think PyUSD is going to be really important going forward because PayPal already has that payments network, right? You can actually go to a point of sale and you can use your PyUSD from your app pretty much now. I say pretty much now, but I mean absolutely now. You can go and use your PyUSD. And that's always been the promise of stablecoins, right? The promise has always been instant payment. And then similarly for remittances, we've been talking about remittances for probably a decade. And yet PayPal has their company called Zoom, I believe, spelled with an X, not a Z, where they can do remittances via PyUSD. So some of these use cases are finally coming about in a way that they kind of feel like intra-bank things, but they're not quite. They do actually have to span across banks to be able to do these things.
And actually, with Zoom and what you just talked about, are there any savings that people are, like the everyday consumer is experiencing through those remittance payments?
Last time I did an international payment, I think I was charged something like 5% or something ridiculous like that. Like FX is stupid.
Wow. So Arin, I want to look at your group for a sec. So Stripe, Interactive Brokers, TokenizeThis now. You guys are setting up payment rails, getting everyone onboarded with stablecoin, with other digital assets, to just say. Like, what exactly are you looking at in the tokenization space? Is it all getting that initial like 0 to 1, just get people on chain, get the rails set up, or kind of a broader vision?
Yeah, no, good question. We definitely have a couple of really cool announcements in the next few weeks that we're excited to make. But really what we're looking forward to is what's going to be tokenized next. So we went from the top down, right? Tokenized the #1 thing, which is the US dollar, which with stable coins. The second biggest thing is probably US Treasury bills with the tokenized money market funds. Third biggest thing is probably going to be real estate. So we're happy to power experiences where someone with crypto wants to invest in tokenized real estate. And ideally, it's we're pretty much use case agnostic in the tokenization space. We're able to partner with any type of RWA that needs to embed a bridge to move from crypto to the tokenized asset and back. And then we also have fiat rails as well. As a US regulated money transmitter, we're allowed to custody fiat, move it around where it needs to go, and help end users especially move in and out of tokenized assets at a pretty fast rate. So yeah, really just excited to see some of the bigger use cases that come to be. And I think right now we're sitting at almost 1.x billion in terms of tokenized treasury bonds. As that grows, we'll power more and more of the rails and probably end up powering most of them. So super excited.
Yeah, I think no matter, so this is what, institutional payments and digital rails, or digital payments and rails, if I'm backwards. But at the end of the day, like, always looking at distribution, I think there's no shortage of potential products and prospective issuers. The real question now is, okay, where is this going to live though? Where, what's the target audience, and what are you doing to connect to that? And that's really where I see a lot of this on this panel specifically about, like, where are these things going to lie? USYC. Copper is supporting it, right? On the collateral posting side, maybe distribution to clients. Like, I'm always thinking that way. Where is everything going to lie, and kind of branch out from there? So,
yeah, and even
Leo,
this week we've been here. Oh, sorry. Even this week, we've been coming up with new use cases and hearing other folks share their opinions. We've talked to a few funds where, because they're on smart contracts, dividends get dispersed almost on a daily basis, where most money market funds would disperse them on a monthly basis. Well, since they're on a daily basis, what if the end user wants to get USD every day or USDC every day as opposed to the token? Well, with Zero Hash, we could technically push USD to a bank account. We could push USDC out on-chain on a daily basis. So I think there's so many more use cases that we haven't even scratched the surface of yet that we're super excited to power.
Yeah, it's really interesting. I think the future of where these things are held is kind of an interesting question. We talk a lot about custody in our world because most financial institutions need some sort of custodian to help them hold these digital assets. That's one of the reasons why we first went to folks like Copper, BitGo, Anchorage, Komainu as our first set of partners, because we knew that institutions needed a place to hold these things. And then the second question becomes, so when we're using them, how are we using these assets? And one of the big use cases for crypto right now is trading. And for trading, we've learned in the last 2 years that we should not necessarily keep our crypto at an exchange, right? Hopefully everyone's learned that over the last couple of years. And if that's the case, the most logical place to hold them are places like Copper Clearloop or BitGo Go Network or Komainu Connect, possibly Fireblocks Off Exchange. Like, these are all things that we're really thinking about as the next evolution of what the crypto market structure looks like. So we're kind of building into that future, saying, well, you should hold USYC as collateral because you should be getting interest on your collateral. But how should you do that? You should probably be doing that through one of these custodians or through one of these other tri-party-like agreements. So we've built everything kind of with that network effect in mind, with that ability to hold these in a more secure format than necessarily at your exchange. Although, you're free to do that as well. I think what you said about the interest on something like a USYC or any other money market token being put out daily is a really interesting comment, particularly because we were mentioning earlier the BIDL fund.
Yep.
So you were mentioning that the traditional money market funds give your money out once a month, right? Which is actually what BIDL does, which is moderately amusing to me because I think that is an example of one of these places where people have taken the traditional product and taken it all the way through traditional rails and then tokenized it at the very end, which I think is a very bad model to follow. In order to be able to do things like you said, where you can pay that interest every day and maybe take it off chain and start to spend it, you really do have to start to think more first principles about how do I create this product where I can do these interesting things, where I can do these useful things, rather than going through all trad rails and tokenizing them at the very end. That's another thing I think about a little bit with like real estate as well. There isn't a whole lot you can do in the intermediary steps before that. So I'm not super confident on real estate tokenization.
I think what Leo mentioned just now, I think just to get a thought, if you look at the settlement process, right, and what the token issuance have been done, say some of the banks have done experimented with bond issuances, etc. Most of them actually just use the ledger as just ownership records. The actual servicing of the asset actually happens outside off chain, and then actually is distributed again back on chain, which is what you're talking about. There is a gap in that, and if you want to get to what Arin was talking about, that really needs a fully encoded digital product, actually, which can be serviced on chain with obviously oracles providing external price references and all this stuff. And that we have not seen in the financial markets, traditional financial markets yet, right? But that's the next step. Hopefully, over the next few years, we'll see as people get more confidence in these issuances to move to the direction.
I think this panel a year from now will have all these use cases, hopefully. So definitely looking forward to it.
We're working on a couple of those use cases, actually. So, one of the hardest things to disrupt is going to be the financial market as it currently stands, right? So trying to put like bond payments on chain, incredibly hard. Like so many incumbent players who do not want you to like mess with their shit. However, I think a really natural fit for some of this, what we're talking about, of having all that servicing done on chain, are what I like to call like naturally digital cash flows or naturally digital assets. So I think of things like video revenues, music revenues, ebooks, podcasts, anything where you're selling an online good, a digital good, and getting cash flows off of that. That's a really natural place for us to plug things like this in. So you can actually take those cash flows directly from the use of the digital asset. Count out those views or count out those minutes that something's being listened to or being watched, and turn that directly into crypto payments. Send that through a smart contract, securitize it, maybe tranche it, send it out to the people who have invested in it. So I think that's coming really shortly. I think this because I'm working on it, but yeah, it's definitely coming.
And Prakash, aside from repo, I know we spent the earlier part of the conversation focusing on that.
Yeah.
On Broadridge's end, you guys power what, $8 trillion daily on the equity, fixed income, everything side. What are you guys looking at beyond that you're able to share, or even client demand? Like, what's exciting that you think you could really start integrating on that side?
So there are a few areas, obviously, where this can head to, right? But we started with this securities financing problem of repos. I think that's got a lot of scope to grow, right? So we would like to expand the coverage of that more to expand geographies, right? All of that will happen over a period of time. Like I mentioned, I think it's key for us to have cash on ledger. So that integration, interoperability with wherever digital cash is available and enable settlement, I think would be the next phase for us to enable. You would have seen that we are also part of this RSM, or Regulated Settlement Network, that the New York Fed has initiated an experiment pilot, right? We are also part of that pilot experiment. So we are exploring all of these to see how best we can kind of put everything together. Like Leo mentioned, existing markets actually is very difficult to change, get everybody to change. There are too many players who will be impacted. And while disruption will come, I think it'll be incremental. And I think our approach has been to kind of incrementally support change and bring in whatever the best tools available to do that. Right. Outside of the tokenization of anything else, yeah, it could. I think if tokenization of alts actually expand, maybe supporting that actually in our wealth platform could be an opportunity. But that needs more work. First, alts itself, actually, distribution in wealth is still a very small percentage. So even that needs to kind of expand, and obviously tokenized alts will be the next big problem. We don't see intermediaries vanishing, right? I think in the morning session, I think somebody asked Jason from DTCC about that too, I think, right? Intermediation, I think what we are making is all players in the process actually kind of more efficient. And hopefully the benefits will be to the end investor, right, with all the savings out of that. I think legally changing structures, we work within the current legal and regulatory structure, right, our products. So given that, I think that's the best we can do, right?
think on the, on the disintermediation piece, we have a competitor in this securitization of digital cash flow space. They're more of a TradFi competitor. They can only do big deals because of how much it costs to do that sort of securitization in the traditional world. And we think we can save about 5% on that whole servicing process. And we send that straight through to our investors. So our investors can earn 5% more than the other, our competitor asset in that space. So I think this sort of thing can be very powerful across the board if we can find the right ways to service those assets, actually.
So I want to touch a little bit on blockchains, right? There's always the debate, public permissioned, private. I know that you guys are Broadridge, right? You guys are on the Canton network, right? So I'm going to get your thoughts. And do you think that capital markets will eventually get to public, or the permission once absolutely needed?
I think that it all depends on regulation, actually, and also a few technical challenges, right? So one key thing we have to remember is actually nobody wants complete transparency. I think, especially in the institutional world, actually, when you're transacting and trading, right? Markets occur because of information asymmetry. And I think a fully transparent world actually puts so much pressure on kind of hiding that information even more, obfuscating it. So I think that's one of the problems with the public blockchains. I think there is a need for public blockchains for a variety of products, and they will thrive on that right now. But public blockchains don't provide actually confidentiality of transactions, right? So, and that's why we are using actually a private blockchain. And not all private blockchains do provide confidentiality. We are using a specific one which provides confidentiality, right? And hopefully that technology, those kind of enhancements will happen in public blockchains too. And when that happens, obviously that infrastructure will be leveraged because it will be lower cost adoption for everybody, right?
It's worth noting that public blockchains and privacy aren't necessarily in contradiction with each other, right? Canton is going to be a public blockchain. It's just a privacy-focused one. So one of the things that you'll find, and I'm going to mangle some of this, so sorry to the DA guys, but conceptually what they're doing is that it's a public blockchain where you can hide whatever information you want. And that information is on-chain, but it's encrypted, and then only certain people can decrypt it. And you can do that for pretty much any field or any information. And that's incredibly important for certain types of regulation, right? Like you can't give out people's personal information, or you can't give out what their mortgage details are. And so there's a bunch of really big use cases where you just can't do it on a fully public, fully transparent blockchain. That's a major flaw in the way some of the big public blockchains work, right? So being able to do that kind of screening is incredibly helpful, and I think why a lot of people are starting to use Canton as their kind of public-private network, or their privacy-focused public network. Now, fully private networks are a different problem, right? And there's a use case for those as well. There's no reason to have a fully public blockchain if you're doing a supply chain problem, for example. And so the only people who matter are the people in your supply chain. Right. But just having that general concept of are private blockchains bad, I think is just, it's a way to rile people up, but every tool has its use, and we just have to be careful about where we use things.
And to your point, Jason, see, there will be a lot of assets which are actually kind of tokenized and deployed in public blockchains. They'll increase over a period of time. At some point in time, even these private networks will need to interoperate with them, and that's already happening. Right? We have seen experiments done by Swift, I think, last year, with Chainlink, a few other experiments. Even the ones actually that morning they were mentioning about Project Guardian involved actually interoperability, right, in some sense. All of those are actually stepping stones actually to going towards the direction. Like Leo mentioned, you can do encrypted transactions on public blockchains, right? But that still leaves a trail. Sometimes you don't even want the trail, but you want the benefits of shared synchronization of state. So it's an incremental growing space. ZK is also misunderstood by many people, right? There's a difference between doing roll-ups versus actually having true zero-knowledge proofs, which are computationally hard today to kind of do it in full scale. So a lot of these things will improve, and as they improve, I think we'll find solutions. And at some point in time, hopefully, we won't be talking about public versus private blockchains.
I mean, I think
that's maybe 5, 10 years away. I don't know.
Yeah, I think there's also some fear with public blockchains of if you're on a public blockchain, you have to hold crypto assets, and we all know with banks and certain institutions, they don't want to hold or touch crypto. So how can they use a public blockchain in the first place where having crypto assets on their balance sheet is seen as something that's not regulatory compliant? We probably need solutions in the space like some sort of gas station that Zero Hash could power where a third party, pays the gas fees and then the institution just needs to sign a transaction so that they don't have to actually interact with the public blockchain and use it as a crypto payment mechanism. They could just use it for the technology and have a trusted third party handle all the fee mechanisms.
Arin, that's a sick case to talk about. I was unaware of that. So thank you. And kind of to that point, like I was going to ask, what's missing right now? You could make a wish list of anything, but that's something that's addressable right now with your group in that case. But even broadly speaking, just on the panel, like what's missing to really kick things into the next gear? If you had something that you could have done, within the next few months, like what would that be?
Yeah, I can go. I think some of the tokenization stuff is great. The technology is now finally being used. I mentioned this earlier, but dividend payments, right? Using tokenization for what it's meant for and be able to settle 24/7, 365 is a big one. Also having easier on and off ramp mechanisms for these tokenized funds where, there's a lot of tokenized funds in the space now, but I'm a retail investor myself. I still don't know what I have and don't have access to, and also an institution, right? Like, there's institutions that are all over the world, especially in Argentina and Venezuela and other places that hold large amounts of crypto and USDC, but they might not have the accessibility yet to even a tokenized fund that's probably meant for them. So it's really just getting more exposure into the space as a whole and showing the investors and the funds that there's a way to connect them and bridge them together.
I think having too many, commercial bank money, digitized form, is going to be a challenge because that'll again fragment liquidity. For cash management, it will become still a challenge. So I think that needs to be solved for. I think today's world it works. If it's a centralized issuer like USDC, it's fine actually because you can go through them very quickly to initiate it. But otherwise, that'll be a challenge. So hopefully we'll have better mechanisms. I do not know whether CBDCs will come into place soon. Depending on the country, I think it'll happen, right? But the US is a little further away, right?
Yeah, sorry. I wanted to spend some time thinking about that. I think I've got like different dimensions in which I'd want things to appear. The first thing that I think we all kind of think, but maybe don't say out loud is like regulatory clarity, and perhaps like less hostile regulation in general, right? The reason banks can't keep cryptocurrency on their balance sheet is not any rational reason, right? Like they've got incredibly punishing capital treatment for some reason, like worse than equities, which doesn't really make sense. So I think regulatory clarity is a big one, and I think that would unlock a lot of the use cases we have. Including digital cash, right? Digital cash would come immediately if regulatory clarity happened. In a completely different dimension, things that look like fraud proofs, things that look like really the ability to hard prove that certain types of contracts are not hackable. This is actually a thing that is doable, but it's quite difficult. And it's extra difficult in a Turing-complete language. But you can imagine maybe a limited scope language for smart contracts where you can prove that certain types of hacks are impossible. And that would be incredibly comforting for the financial world, right? So being able to do that sort of verification, like formal verification of your smart contracts would be an amazing thing to have instantly, probably impossible. Yeah, those are the first two things that come to mind.
Yeah, it seems like a phased approach, right? I think phase one is let's go out and tokenize everything. Phase two is, all right, how do we move these things around, which I think the Benji token actually just enabled to be able to transfer these tokens. Phase three is how can I use these assets to potentially get a loan or actually do things that I would in normal TradFi but faster. I mean, today if you had a bunch of TradFi assets, regular assets, the way you would show proof of ownership is by showing a brokerage statement or screenshot of your brokerage statement. Whereas we all know with tokenized assets, you could easily just sign a transaction saying, I own 100 million of BIDL token or something. I think we're getting there, and it's a phased approach, but those are probably the use cases and experiences we all look forward to of being able to use these tokenized assets for what the future is really meant for them to do.
A wallet that doesn't suck would be nice.
Definitely. And I mean, a lot of this, at the end of the day, this is coming back, like the focus here on the institutional side. We need to make sure the actual existing legacy players are making good use of this and there's something in it for them, right? Like, this is all great as retail investors thinking about the wish list and what we need, but we also are kind of looking at it from let's just say a higher up level or a deeper level, the opposite of that. So that's something that's still being addressed heavily, still using, we've been talking about the private chain side, the public chain side. Like, it's baby steps to really figure out what works. I think Broadridge's repo was a slam dunk. I remember reading about that when it first came onto my radar in a field that, fights for basis points. Like, how could you ignore saving, even 10 bips on a transaction? Trillions of dollars on a daily basis, you simply can't ignore that. I think there's a lot of cases out there. We were talking about the mortgage industry. We were talking about just interest payments as a whole, daily streaming. Like, there's so much opportunity. It'll all come down really to the payment rails. How is the end user accepting payments? How is the actual servicer or someone in between, or the actual issuer kind of front man sending that out? So it all kind of comes back to the rails here. I know we only have a few minutes left. If there's any kind of parting thoughts from the crowd, or if we could do a Q&A, or Jason, if you have something on your end, happy to open it up.
Oh, let's open it up. Any parting thoughts? Otherwise, crowd, if anyone wants to yell out a question, feel free.
I can do a parting thought.
Please do.
I think one of the great things about this panel has been that everyone here is like talking about really serious use cases and how we can do things that improve things within finance. I think more than half the projects I see don't actually try to improve something that in traditional finance. They really think, how can I improve this in crypto? And the problem with improving things in crypto is that A, it's really low-hanging fruit. Like, it's kind of a low bar, rather. Not really low-hanging fruit, but a low bar. And if you're not improving past traditional finance, you're not actually improving like the things in the real world. Because we should always be thinking, hey, as an investor or as an individual, I have the choice of doing all these things either in the traditional world or in the crypto world. So personally, like, I keep most of my money in the traditional world. I bet most people within crypto do too. So even though they evangelize this kind of debanked world, they actually don't talk the talk. They don't walk the walk, right? Mm-hmm. And you gotta wonder why that is. It's maybe because they don't feel that secure keeping all their money in a wallet that can be wrench attacked away from them. But there are many other reasons as well. So we should always be thinking, like, does this do better than my traditional finance counterpart? And that's actually the metric that we always use in terms of if we're going to onboard a new product, if we're going to create a new product, how is this better, or why is this better than what we used to do in TradFi? And if it's not better, don't waste the energy to do it, right? Like, you're not going to outcompete TradFi. They have more resources than you. They have a better product than you. Like, what are you doing? So yeah, I just really urge people to think about the kind of global perspective of why this is better, not just the local perspective of like, would this be cool to have in crypto?
You mentioned that the USYC it's an equivalent in the new industry to the money market. Am I correct?
Sorry, could you repeat that? Sorry.
Here, I'll bring the mic.
Is USYC equivalent to a money market?
It's similar to a money market. It's not equivalent. So it's our USYC. It's not stable. It is fully backed by reverse repo rather than like a portfolio of treasuries and such. And it's mostly because we're there to replace collateral. So one of the reasons it's not stable, for example, is because if you have a stable token and you're holding that at either your custodian or your prime broker or your exchange, then one of those entities has to keep track of how much interest they owe everybody, right? As money comes in and out of probably their universal wallet for everybody, right? That omnibus wallet has to keep track of everybody's inflows and outflows and then figure out how much interest they owe everybody at the end of the day, or at the end of the week or month or whatever their cadence is. Whereas with our token, you just keep track of how much collateral is posted, and you can give exactly that much collateral back, and the value has accrued within the token, which makes it much, much easier to use than a stable token.
So you just said that a lot of people in the space do not use the digital, but they still use the traditional, right? Do you keep your money in the USYC?
So when we trade, we keep our money in the USYC because that's how we accrue interest in the collateral.
Not your trading money, your money.
We made this for a trading collateral, not as a savings device, which is actually something we say to people all the time. I think as a savings device, you should keep your money probably in traditional finance right now. But for trading, if I want to get my money from exchange A to exchange B quickly, this is much faster and allows you to earn interest on that collateral in a way that you can't do with traditional finance, and you can't do with the digital equivalent, like the stablecoin counterparts either.
All right, thank you.
Any parting thoughts? Oh.
You mentioned use of formal verification of smart contracts. Where do you see that's value, and where do you see the responsibility for bringing actual verification to the process?
Yeah, formal verification. Okay, so yeah, for these sort of things, I think, so from the math world, right, formal verification comes up a lot. From the smart contract world, like I think if you have a limited set of things, being able to prove that something is unhackable or that you cannot get funds out of a smart contract without certain conditions can be super valuable, right? And that can be part of an automated audit process. So that's where I see that coming into play. What was the second part of your question again?
Just how do we make that financially viable? And coming at it from the math and computer science point of view, got it, right? Like that's, you know.
Yeah, super cool.
Yeah, no question. But how do we make this work economically?
Well, that might be one of the reasons why it doesn't exist yet, but also, I bet people would pay for that. Like, I know that if you were a bank and you wanted to do something smart contract-wise, it is infinite liability for you to be putting money into that smart contract. Whereas if you can do a formal verification that that is an unhackable contract, right, all the banks will come and do business with you. I think if you could make a formal verifiable contract that does, I don't know, tri-party through your bank, right, you would get all of the bank's businesses.
Yeah, maybe in the true DeFi model, you could actually have an insurance contract actually which got a treasury which will fund automatic verification audits. That could also be one economic way of doing it.
All right, we're coming up on time. So Prakash, Arin, any parting thoughts before we hop off?
Thank you, guys, and having us here. And
Yeah.
it's a pleasure.
Yeah, thanks everyone. I'll just leave one parting thought. I think sometimes crypto gets a bad rap in the media due to speculation, meme coins, and all that crazy stuff. I think it's this group right here that's actually reverse degenning the entire industry, meaning there's nothing speculative about treasury bonds, there's nothing speculative or meme coin about 5.3% yield on treasury tokenized funds. So I'm really excited to clean up the space and bring real utility to the people.
Fantastic. And with that, we'll be closing out this panel. Please give a round of applause to our fantastic panel here.